Procter & Gamble has implied volatility of 27.91%. Apple, on the other hand, has implied volatility of 31.9%. Which stock has more expensive options right now? If you said Apple, you got it wrong. And that mistake is costing most traders a lot of money every single day, simply not knowing how to read implied volatility correctly. Raw implied volatility tells you absolutely nothing by itself. Every options chain you'll see has an implied volatility number. Now, most traders at a glance will just look at Apple, see this 31.9%, then take a look at PG, Procter & Gamble, or their scans, see 27.9%, and by default assume that Apple options have more volatility, they're more expensive. Now, that assumption is incorrect and leads you to spending much more on options than you need to. Here's the problem with that assumption. Implied volatility is relative. Apple's 52-week IV range runs from 19.5 to 71.2%. You can see that in Thinkorswim here. That range gets stretched wide by quarterly earning spikes, things of that nature. The current implied volatility is sitting at 31.90% with the latest market volatility that we're seeing. Now, Procter & Gamble, on the other hand, if we take a look at some of that, the 52-week IV range you'll notice is much tighter, 15.8% to 37.8%. The current implied volatility is sitting at 27.91, right in the middle, but also closer towards that max of 37.8. Selling premium on Apple at 31.9% implied volatility means you're collecting cheap premium relative to what Apple typically offers. Selling premium on Procter & Gamble at 27.91% means you're collecting premium that's richer than usual for Procter & Gamble. It's all relative to that particular stock. The raw implied volatility number, it hides all of this completely. Now, IV Percentile strips away most of this noise. It answers one question, and that question is what percentage of trading days over the past year had lower implied volatility than today? The formula is quite simple. You take the number of days with IV below the current IV, divide that by the total number of trading days in the period, and multiply that by 100. So typically, you have a 252-day trading day look back period. So say you had 139 of those 252 days, which had lower implied volatility than today, then your IV percentile would read 55%. If only 60 days had lower IV, then it would read 24%. The metric does not care about extremes. It does not care if implied volatility spiked to 100% for 3 days during earnings. It treats every trading day equally, and a 1-week spike represents 5 out of 252 observations. It can't dominate the entire reading. That's the beauty of this metric. Now, Procter & Gamble, at its current implied volatility, is trading at 27.91% implied volatility. In isolation, we said that raw number means absolutely nothing. What does matter is Procter & Gamble's IV percentile, which currently reads 55%. Current IV is higher than 55% of all trading days over the past year. That's what that's telling us. Now, Procter & Gamble, if you think about it, it's a consumer staple. It does not spike like a tech stock. Its IV range, we can see very clearly, is narrow. So when IV does creep above the midpoint of its historical distribution, that's quite meaningful. That's something we want to pay attention to. Now, an IV percentile of 55% on Procter & Gamble represents a much more genuine shift towards more expensive options relative to what the stock normally offers. So now all of a sudden, strategies like covered call or selling a short put would help you collect a little bit better than average premium. And you can layer on things like our covered call calculator to help find some of these anomalies a little bit easier where you're collecting rich premium. Now, Apple's current implied volatility is 31.9%. So it's higher than Procter & Gamble on that raw value, but we've already talked about the IV percentile, which in Apple reads at just 24%. Now, that current IV means that that percentile means the current IV is only higher than 24% of trading days. So for 3/4 of the past year, Apple had IV greater than what we're seeing right now. that tells us that we're not really in that upper end of the implied volatility range. We've seen it creep much higher, 71.2% high from the last cycle, which stretches this range. And it might distort it a little bit, but very clearly it tells you that the current reading of 24% is low. Apple options are cheap relative to what the stock normally offers. Selling premium on Apple right now would also mean that you're collecting less or below average premium. Buying options, on the other hand, means you might be getting a little bit of a deal or getting them at a discount compared to typical levels. Now, use all of this to actually impact your trade decision. That's, I think, what we care about as traders. And without IV percentile, if you were to just run a scan, you'd see both stocks, Procter & Gamble at 27.9%, Apple at 31.9%, and most likely gravitate towards selling premium on Apple because that number is just on an objective level higher. That trader, however, would collect below average premium on a stock in a low implied volatility phase, and you would completely ignore what is actually the ripe opportunity with the above average premium inside of Procter & Gamble. With IV percentile, this picture flips a little bit, and you're able to weigh the scales a little bit easier. Procter & Gamble at 55% signals above average premium. That means sell premium strategies have an edge here. Apple at the 24% IV percentile means you're getting below average premium. Buying strategies here are a little bit better. The stock with the lower raw IV is the better premium selling candidate in this case. And IV percentile is what helped you uncover this, not the raw implied volatility. Now, to find all of these IV percentile metrics, you can do that very easily in Thinkorswim. If you go to the trade tab for whatever symbol you're looking at, and underneath today's option statistics, you'll be able to see the IV percentile by default. You don't need to do anything inside of your platform. Now, the platform labels you'll notice across different platforms will be inconsistent. You'll see that Tasty Trade shows you something labeled IVR, but that is IV rank, not percentile. You'll notice the numbers are similar, but also these calculations will vary across platforms. So find a platform. I like to just stick to Thinkorswim and let that be your baseline, if you will. I hope you found this video helpful for those of you looking to understand how to use IV or implied volatility in your trading. Hopefully through this video you understood the difference between raw implied volatility and IV percentile and why you want to use one versus the other. Very clearly in this case, I tried to make the argument for why I think IV percentile offers you much more useful information. Take care, good luck trading, and I'll see you in our next update.